These principles will now be illustrated by working through example 9.1 in Introduction to Consolidations, Chapter 9. Focus on the following when working through this example. The split of the profit of S for the pre- and post-acquisition periods is something new added to this example that you would not have seen before, that is only applicable to an interim acquisition. Some of your consolidation journal entries are affected by this, and I'll point it out. Your consolidated SPLOCkie is this statement that's affected by this interim acquisition the most. You will clearly see the effect of this line by line in the SPLOCkie. Please make sure that you have a look at that. Your consolidated SFP is not affected by an interim acquisition, as you prepare an SFP at the end of the reporting date at a specific date. Your consolidated statement of changes in equity not affected that much. There's one new line item that you need to see that we will have a look at. Example 9.1 looks at the consolidation process with an interim acquisition. B Limited acquired a 70% interest in the ordinary shares and a 40% interest in the preference shares of S Limited. So this example immediately integrates with Chapter 8. The acquisition date is 31 March 29, and both companies have a 31 December reporting date. That tells you we are dealing with an interim acquisition. On 31 December 29, the end of the current reporting period, the trial balances reflected the following. So I'm going to do the consolidation of this group for the year ended 29, which is also the year of acquisition. There you can see the two investments by the parent, the ordinary share capital and preference share capital of the subsidiary. And please note the retained earnings provided in this trial balance is now on 1 January 29. That is no longer acquisition date. That is now the start of the reporting period, but not acquisition date. Your acquisition date is 31 March 29. Moving down on the trial balance, you then are looking at profit for the year. This is the entire profit of the subsidiary for the entire reporting period. What we will note in this example is that your income and expense items, a lot of detail are provided on these items. And based on the brief introduction we had, why do you think that's necessary? This profit of S, you will have to split in a pre- and a post-acquisition period. And you can only do that if you have detailed information about the individual income and expense items included in that profit for the year. Then there was a preference dividend declared by the subsidiary of 10,000 Rand at the end of the year, and also an ordinary dividend declared by the subsidiary at the end of the year as well. Please note that because it's only declared, you have this line item, shareholders for dividends, also included in your trial balance now. The dividend was not yet paid at reporting date. When you look at the additional information, all your bullets from the start up until there is everything you need for at acquisition date purposes. Your acquisition date is now 31 March. The identifiable assets and liabilities were considered to be fairly valued. The share capital didn't change. The preference share capital of S still consists of 100,000 cumulative preference shares with an annual dividend of 10 cents per share. The preference dividend was not in arrears at any stage. And in the current year, the 29 year, you can see on the trial balance that a 10,000 Rand preference dividend was declared. But remember, when we look at this later on, your preference dividends accrue over time. It's different from an ordinary dividend. P Limited chose to measure NCI at the date of acquisition at fair value. The fair value of NCI in the ordinary shares and NCI in the preference shares are given as 65,000 and 55,000. The only effect of the interim acquisition is that I have to give you those fair values at acquisition date now. It is P's accounting policy to account for investments in subsidiaries at cost in its separate financial statements, so your TB amounts represent the consideration paid. What is the one piece of information that you were not given as part of the at-acquisition information? It is your at-acquisition retained earnings. And that is a big focus of an interim acquisition because you were not given the at-acquisition retained earnings. You need to reconstruct the available information to calculate that retained earnings at acquisition date. And to help you with that, the following bullets provides you with detailed information regarding your profit and loss items. You will not be allowed to just take the total profit of the subsidiary and say, that profit times 3 over 12, because my acquisition date was 31 March, is pre-acquisition profit, and that profit times 9 over 12 is my since acquisition date profit. Very seldom will you conclude that every single income and expense item accrued evenly throughout the year. You need detailed information to enable you to do that split. The first bullet says both companies maintain a constant gross profit percentage and that sales occurred evenly during the year. So it is possible for something to accrue evenly, but you cannot assume that for every income and expense line item. This bullet will help you to calculate revenue and cost of sales. Then they tell you that since 1 April 29, the subsidiary and the parent entered into a lease contract. S Limited leases equipment from P Limited at a monthly fee of 3,000 Rand. Now, because you know that this contract was entered into on 1 April only, the entire lease expense of S Limited belongs in the post-acquisition period. Right. Then there's a loan. You would have picked that up on the trial balance as well. P Limited granted the loan to S Limited on 1 July 20X9. That is since acquisition date as well. This loan carries interest at a market-related interest rate of 10% per annum and is repayable on 30 June 2011, which is just 2 years down the line. So this gives you information about the loan. It's still outstanding, and the interest. But I'm talking about income and expenses here. So what does this tell me about the interest expense, the finance cost of S? It's also fully related to the since acquisition date, the post-acquisition date period. When you see interest like this, 10% per annum, no further information, it's simple interest, not compounded. Then they tell you that profit before tax of both companies is equal to taxable income, except for dividends that are not taxable. Right, so that we're going to use for our income tax expense calculation.